I put $10,000 into 3 different ETFs, and one of them is paying me almost 3 times more in dividends than the others. This is a head-to-head comparison of SCHD, JEPI, and SPY, 3 of the most popular ETFs in the dividend investing world. But one of these funds has a hidden catch that could quietly drain your long-term wealth, and most investors never see it coming. If this is your first time here, I'm Dividend, and this channel is all about helping everyday investors like you build real passive income through ETFs and dividend investing. If that sounds like your goal, hit that subscribe button and tap the bell so you never miss a breakdown like this one. Let's start with the basics so everyone's on the same page. SCHD is the Schwab U.S. Dividend Equity ETF. It targets high-quality U.S. companies with strong dividend histories. JEPI is J.P. Morgan's Equity Premium Income ETF, which combines stock exposure with a covered call strategy to generate extra income. And SPY is the granddaddy, the S&P 500 index fund that tracks the 500 biggest companies in America. 3 very different approaches, but the same $10,000 starting point. So which one actually puts more money in your pocket? Let's talk dividend income first, because that's why most of you clicked. Using current yields, SCHD pays around 3.5% annually, JEPI pays approximately 7 to 8% annually, and SPY only about 1.3%. So on a $10,000 investment, SCHD pays you roughly $350 per year, JEPI pays around $750 per year, and SPY pays just $130 per year. On paper, JEPI wins the income round by a massive margin, but here's where it gets complicated, and this is exactly why you need to keep watching. JEPI's high yield comes with a trade-off. Because it uses covered calls to generate that premium income, it caps your upside during strong bull markets. In 2023, SPY returned over 26%, SCHD returned around 4%, JEPI returned roughly 9%. So when the market ripped higher, JEPI investors left serious money on the table. That means your $10,000 in SPY grew to about $12,600. In SCHD, it grew to $10,400. In JEPI, roughly $10,900. Total return, income plus growth, tells a very different story than yield alone. Now let's zoom out and run a 10-year projection, because that's where compounding changes everything. Assuming consistent reinvestment of dividends and historical average returns, $10,000 in SPY grows to approximately $43,000 over 10 years at a blended 15.8% annual total return. SCHD, with dividend reinvestment and an assumed 10% total return, reaches about $25,900. JEPI, assuming 8.5% total return, lands around $22,600. SPY wins long-term growth, but SCHD and JEPI generate far more actual cash income along the way. Your goal determines your winner. Here's how I think about who each ETF is actually built for. If you are 25 to 40 years old and decades away from needing income, SPY is your most powerful compounding engine. If you want dividend growth and quality with reasonable yield, SCHD is your sweet spot. Dividend raises year after year, backed by fundamentally strong companies. And if you are at or near retirement and need maximum monthly cash right now, JEPI delivers. Just understand you're trading growth potential for current income. There is no universally best answer. The best ETF is the one that matches your specific financial timeline. One more thing nobody talks about: tax treatment. SPY and SCHD dividends are mostly qualified dividends, taxed at the lower 0%, 15%, or 20% capital gains rate, depending on your income. JEPI distributions are largely ordinary income, meaning they can be taxed at your full marginal rate, potentially 22%, 24%, or even 32%. On $750 of JEPI income, that extra tax hit could cost you $60 to $150 more annually compared to SCHD. Over a decade, that difference compounds. Always hold JEPI inside a tax-advantaged account, like an IRA if possible. That single move can save you thousands. So here is the final breakdown. For maximum long-term wealth, SPY wins. For the best balance of income and growth, SCHD wins. For maximum monthly cash today, JEPI delivers. Just use it in a tax-sheltered account. Personally, I hold all three, SPY for growth, SCHD as my dividend core, and a small JEPI position inside my Roth IRA for tax-free income. Diversification across strategies, not just assets, is how you build a truly resilient income portfolio. If this breakdown helped you, smash that like button. It genuinely helps this channel grow. Share this video with a friend who's trying to figure out where to put their money. And if you haven't subscribed yet, now is the time. See you in the next one.